So, a 1% pension fee. Sounds completely harmless, right? I mean, it's just 1%. It's practically invisible. You look at that tiny little number on your statement and think, sure, take 1%, no big deal. But what if I told you that over the next 30 years, that quote-unquote tiny fee is actually quietly doing catastrophic damage to your future? Yeah, you're looking at a staggering loss of over $180,000. Just let that number sink in for a second. That tiny little percentage can quietly drain a massive chunk of your retirement. And honestly, the absolute worst part about this whole thing is that most of us paying it have literally no idea where our money is even being invested in the first place.
Which brings us to Section 1, the trust everyone has, or why we treat our pensions like background noise.
So, how exactly do we manage to lose hundreds of thousands of dollars without even blinking? Well, it's because it's an automated illusion. Think about it. Step 1, the money magically disappears from your paycheck before you even see it. Step 2, your employer tosses it a match. And step 3, the numbers just slowly go up over time. Because this whole process is so incredibly frictionless, our brains just naturally assume that, some really smart people behind the curtain are handling everything perfectly for us. But man, the reality is a lot darker. Because of this blind trust, there is a whole laundry list of things almost nobody actively checks. We don't check what we actually own. We don't check the specific fees we're paying. And we rarely, if ever, check whether the returns are actually any good. We just blindly trust the system, kind of figuring that because it's an official pension, it's already optimized for us.
All right, Section 2. Let's look at what a pension fund actually is, right, behind all that academic jargon.
Let's strip away the boring finance speak for a second. At its core, a pension fund is basically just a giant pool of money. That's it. Millions of regular people, like you and me, chucking our cash into this massive pool. These fund managers take all that money and put it into stocks, bonds, real estate, maybe some private companies. And hey, in theory, this is awesome. Your money grows safely for when you retire. But behind the scenes, well, things get way more complicated and honestly, way more expensive.
Moving right along to Section 3, the hidden fees expose, and how percentages hide a massive wealth drain.
Now we're getting into the real core of this explainer. This is the part almost nobody notices until it's way too late. See, when you have a pension, you are rarely just paying one simple, transparent fee. Oh no, you're getting hit with a whole stack of them. You've got a management fee, an admin fee, transaction costs, sometimes even a performance fee. The entire financial industry literally thrives because these percentages feel so emotionally small to us. When they say, oh, just 0.5% here or 1% there, our human brains just totally fail to register it as a threat. But here is the absolutely crucial takeaway. We are always taught about the magic of compounding, right? How your investments snowball over time. Well, fees compound too. Every single dollar taken out in fees today is a dollar that cannot compound for you over the next 30 years. It's working against you. Let's look at a super simple example to put this into perspective. We've got two identical investors. Both are putting away exactly $300 a month for 30 years. Let's also say they both get the exact same market returns. The only difference here, the fees. On the left, our first investor is in a standard pension fund, charging a 1.2% fee. On the right, the second investor is just using a simple index fund, charging a tiny 0.03% fee. Because of how those fees compound over those 3 decades, that first investor, the one paying the standard 1.2%, ends up losing more than $180,000 by the time they retire. I mean, just look at that. That is the devastating cost of not paying attention. Over 180 grand, just gone.
Which brings us to Section 4, why we never notice, the psychology of invisible theft.
Seriously, why aren't people marching in the streets over this? Well, it all comes down to psychology. Think about it. If someone stole $300 from your wallet today, you would notice immediately. You'd probably call the cops. But if a massive financial institution quietly reduces your entire retirement by 15% over a 30-year period, most people never even look. That massive emotional disconnect between an immediate theft and a slow, long-term fee extraction is exactly what these funds are banking on. All right, Section 5, what they actually invest in, or the illusion of customization. This is where it gets incredibly frustrating, especially when you look at what they're actually doing to justify these high fees. A lot of us have this illusion of some bespoke, highly curated portfolio. But the reality is, your money is usually just sitting in a broad default fund practicing something called closet indexing. What does that mean? It means they are charging you expensive active management fees while secretly behaving almost exactly like cheap index funds.
There is no genius stock picking happening here. They're literally just mirroring the market.
So we're left with this massive, frankly infuriating mismatch. You are paying a premium price for what you think is elite active management, but you're actually receiving a completely generic index fund product. It's like you're paying for a Ferrari and they hand you the keys to a bicycle, all while those compounding fees just ruthlessly eat away at your future.
But before we get too cynical, Section 6, the important balance, and why pensions aren't entirely useless. Now, I need to be absolutely crystal clear about this. Please do not go call HR tomorrow and cancel your contributions. Participating is absolutely still better than doing nothing at all. And the biggest reason for that is the employer match. That is essentially free money added straight to your compensation package, and you don't want to leave that on the table. Plus, many pension funds really do outperform keeping your cash under a mattress. The real issue, the thing we desperately have to fix, is simply that most of us never rigorously compare what we're paying versus what we're getting. You have to monitor it. Which leads us to our final part, Section 7, taking back your retirement and your action plan.
It is officially time to take back your retirement, and here is exactly what you need to do. Step 1, log into your account and check those annual fees. Go find that actual percentage. Step 2, check your fund's historical performance. Step 3, compare that performance to low-cost index funds just to see if you're actually getting your money's worth. Step 4, absolutely make sure you understand your employer match and that you're maximizing it. And Step 5, review your asset allocations. Whatever you do, just promise me you won't ignore your retirement accounts for the next 20 years. Look, your pension might literally be the largest single investment account you will ever own in your entire life. And yet, somehow most of us understand less about it than we do about our monthly Netflix subscription. It's crazy, right? We will sit there and spend 3 days reading online reviews to buy a $20 toaster, but we completely ignore a $180,000 drain on our life savings. So I'm going to leave you with this final thought. Have you ever actually checked your pension fees before watching this explainer? Be honest with me. Better yet, I challenge you to go log in right now. Go find out exactly what annual fee your pension is charging you and drop that exact number in the comments below. Let's expose this invisible theft together and see what everyone is actually paying out there. Take control of your numbers, guys, because I promise you nobody else is going to do it for you.